In this video, we'll talk about the 4 questions we get from all of our retiring clients. When can I retire? How much can I spend? When should we draw Social Security? And what happens if something goes wrong? We'll walk through a real life scenario, so stay tuned.
So we get 4 common questions, and we'll kick it off with the first one. The big question that we get: can I retire?
Yeah. And what we thought today, instead of just talking, was to really show a plan in action, show actual real life scenario of someone headed into retirement, so we can walk through and answer those questions just like we answer those questions for clients. And so we're going to start by introducing our real/fictitious couple, and that's the Andersons. So we have John and Mary Anderson. John's 61, Mary's 59. And the question they're asking is, can we retire? Specifically, John wants to retire at the end of 2024. So looking at their scenario, we can see here, John wants to retire in 2025. Mary's planning on working another 3 years until 2027. Right now, they make $192,000 of income. Their expenses are $136,000, including taxes. In assets right now, there's about $2 million in investment assets. So it's $485,000 in a joint investment account with Fidelity. And then John has $892,000 in his 401k, and Mary has $687,000 in her 403b. 75 grand in cash. The house is worth $490,000, and they owe $172,000 on the mortgage. So this is John and Mary. And like we said, the goal, John says, hey, I'd really love to have for this to be my last year, 2024. So can we retire? And we're building a plan out to really answer that question. Can they retire?
So when we build out the plans, we gather all the information.
Mm-hmm.
We have a snapshot of their current situation.
Mm-hmm.
Once we receive this snapshot, how will we go about answering the question for them as far as can he retire? And I guess the second question there is, when can she retire?
True. And it really is driven off of spending, right? So when we say, can I retire? The answer is, it depends on how much you have and how much you want to spend. So when we look at John and Mary, we can calculate. They ask, hey, can we retire in addition to the mortgage? We really need $6,000 a month after taxes. And so we put that in. And what we can see here when we jump into their income plan that we built is that if they choose to retire January 2025, they can spend $11,500. Now that's actually gross. So if we jump into here, we've got a net income of $9,310. So if they retire 2025, they can spend $9,310. So when we look at that, those are a little more than their income goals. That's good news. It's really good news. So we'll look at the cash flow. What does the cash flow look like long term? And this chart really shows a lot of the different moving pieces of their retirement plan. So you'll see that on the bottom here, we're going year by year from 2024 all the way to 2060. And what we're looking at here is this blue is the monthly income from John's salary, and this light blue is the monthly income from Mary's salary. So you'll see his blue goes away. 2025, he stops working. Mary continues working. This black is what we see is portfolio withdrawal. So that's us taking money out of their investment accounts, specifically the retirement account, and using those to live off of. So what you're looking at is what life would look like on an ongoing basis. As you'll see, this goes up over time because inflation, life gets more and more expensive. We have them drawing their Social Security. So John at 65 years old, and then we have Mary waiting until 67 years old to start drawing her Social Security. So John is in the yellow, Mary's in the purple. And then these two really big steep gaps you see here, there are two big goals that they identified. What they said when we met with them was that when Mary retired in 3 years, they'd really like to take a month and go to Europe, really live it up, travel around. And so we budgeted in $30,000 for them to do that in 2027. And then you'll see they have a daughter, and they plan on paying for her wedding. So they also wanted us to budget in. We have it scheduled at 2030. Who knows when it'll actually happen? But we budgeted in a $30,000 wedding for them as well, or $25,000 wedding for them to pay for their daughter's wedding. So even with those things built in and expected, the plan looks really good, and they can really sustain this lifestyle going forward. And so the answer was yes, based on your expenses and what you need, based on the assets that you've accumulated, and based on you, John, working one more year and Mary working another 3 years, you all can retire. And you can retire and afford to spend on a monthly basis $9,310 a month net.
Once we answer the questions of can I retire, which kind of rolls into when I retire, how much can I spend? Another question that we commonly get is in relation to Social Security.
Yeah.
They want to know when can they draw, or when should they draw on their Social Security?
Yeah. And that's a really good question. And there's a lot of moving parts on drawing Social Security. One of them is longevity or life expectancy. And that really ties into the break-even point for you. So the break-even point is when you have been paid out enough money that it rewarded you for waiting past age 62 to start drawing Social Security. So there's a certain amount of money that you're going to earn if you start drawing Social Security at age 62. And then your payout monthly goes up by waiting to age 65, 67, or age 70. And based on the year you start drawing, we can calculate a break-even point. And that break-even point is the time in which you made more money because you waited than you would if you started at 62. Your break-even time changes based on your full retirement age and the full payout. So for each person, that break-even point is different. And it's different whether you start drawing at 64, 65, 67, or 70. So we can show how we talk about it, and how we came to the decision for him to start at 65 and for her to start at 67. But this is really a collaborative conversation with the clients, because life expectancy comes in and a lot of other things pop in this. So what we jump into building the plan out, we can do an estimate. So currently, John is making $92,400 a year in his last working year of 2024. Right now, Mary's making $99,600 a year. And so when we calculate based on that, we have an estimate that at full retirement, which is age 67 for John, his Social Security payout would be $3,039. And that for Mary, her full retirement would be $3,129. And so we can look at that and say, okay, we have an option to start as early as 62 for John. That payout per month starting then would be $2,127. Or we could delay as long as age 70, which at age 70, that payout for John would be $3,768. But we also know that you pay a price for waiting, right? If we go back to age 67 for John, for him to wait 5 years between 62 and 67 to start drawing his Social Security, he would have to live past age 78 in 7 months for him to have received more money by waiting than if he'd started at 62. So there is a trade-off when you defer Social Security. The other big trade-off is that we would have to be paying for their expenses out of their investment portfolio, right? If we're not going to turn on Social Security, if we're not going to start drawing out of that pension for them, then we're going to have to be taking more money from his investment portfolio and not able to let that money grow for that 5, 6, 7 years. And so there is a trade-off. Same thing for Mary. There's a trade-off. Her full retirement age is 67, but if we had moved it up, she can start drawing earlier. That will help alleviate some of the cash flow, but she'd have to live past age 78 for it to make sense for her to defer. So what we're doing by scooting his Social Security up to age 65 is one more month, is they only go about 1.5 years from when she retires and stops earning money to when his Social Security kicks in. So we're not spending very much time only living on their investment assets. And the other thing that allows is her Social Security is estimated to be higher than his. So it does make sense that we defer her Social Security back a little bit further to let it accumulate and beef up a little bit more. A, because she's younger than him, and B, because women live longer statistically. So by us staggering these two Social Securities to where they don't have to live solely on investments for very long, but also we can let hers accumulate, it gives us a longer, more sustainable income for them in retirement. And once she starts drawing her Social Security, as you can see, and then when we jump back in, they have a significant amount of their needs met on Social Security alone because we waited. Yeah.
A big question that people have, and it's probably one of most people's biggest questions or concerns as they go into retirement.
Mm-hmm.
What happens if something goes wrong? Going wrong being the stock market goes backwards, your investments go backwards. There's a lot of different scenarios that factor in stuff going wrong, but just talk through how we prepare our clients for what happens if something goes wrong.
Yes. This really ties into that 4% rule we talked about in our last video, because the 4% rule is a starter point on how much you can draw out of your portfolio. But what we know is that life happens. So the stock market goes up and down. You have different returns. The cost of healthcare changes. Taxes change. Everything changes. And so we employ a system called guardrails. And what these guardrails allow us to do is to make adjustments along the way as your investment portfolio goes up or down. And we can calculate your spending based on how your portfolio goes. So let's walk through this scenario for the Andersons. So for the Andersons, we have calculated that they can spend $11,500 a month gross. But the question becomes, what happens if the stock market goes well? And what happens if the market goes down? So we dive into these guardrails for them. So we calculate that when they start retirement, their investment portfolio total will be at $2.2 million. And we've calculated that they can spend $11,200. That's what we can draw out of the portfolio monthly. The good news is if the market were to go up, so this is a 5% increase, so their portfolio moves up to 2.33 million. A 5% increase actually gives them a 5% raise. So they can actually spend or draw out $600 extra a month. But this also counts downward. If we were to experience negative stock market return, if we were to experience the portfolio drop significantly, then we can choose to cut back. The good news is that we don't have it at a 5% dip where it triggers you to change your spending. We have it at 30% in their plan. So if the market were to go backwards 30%, which means that their total investment portfolio drops $670,000, then we would need to cut back 5% from their spending. So as you can see, we've started at a place where it does not take a lot of upside stock market return for them to be able to spend more money, but it does take a significant dip, 30%, something that usually doesn't happen very often, for them to have to cut back expenses on a monthly basis. And because of this, because we can make adjustments along the way, we can start them at a spending rate that's higher than the 4% rule, but we have to have buy-in from them and have a conversation that says, in the event that we go through a significant downturn, we have to be prepared to cut back our monthly spending.
I think the guardrails are important because without them, there's a lot of uncertainty in how much you can draw if things go well, as well as how much you can draw if things go backwards. A lot of times you don't know. You don't know you have a 30% cushion until you have to reduce your monthly spending. So, and I haven't been in this situation, but I can imagine if my 2.2 goes backwards any at all, right, to 2.1 or 2 million or something not even close to 30%, I will be concerned if I can continue to spend how I currently spend.
Yeah.
So being able to show, hey, you got room here. I know the stock market has gone backwards. Your portfolio is currently down to 1.8. But we're still in position to where you can draw and live comfortably where you currently are. So being able to provide that peace of mind goes a long way for clients when they're in retirement.
Agree. And when we show them a plan and we say, this is how much you can spend, we let them know, the numbers are on their side. The next thing they ask is, okay, but show me the worst case scenarios, right? If I'm going to leave behind my W-2 job and income, if I'm going to leave behind the life I know that I'm comfortable with a paycheck every month, I want to know what happens if I retire and we go through another housing crisis or we go through another stock market shock. And so what I really like is that we can actually show them their plan going through some of these other scenarios that they have lived through, but maybe weren't at the edge of retirement. And so we jump into this retirement stress test. And what we can talk through is what would have happened if you retired in November of 2007, right? And so what they're looking at here is pre-retirement is 06. And what would have happened if they retired here? They were expecting to be able to draw $12,300 and the market went down, right? What would have happened? And so what we see is that they had to cut back, right? They had to cut back $1,400 a month. And they had to do that from February 2009 to June 2013. And then once the market recovered, they got raises. And so for the rest of retirement, they were above plan, right? So we were 100 above plan. And then eventually in the last 10 years, last five or 6 years, they were $3,000, $4,000, $6,000 a month above what we had expected. So we can make these adjustments even when things go really wrong, like 2008. Some people also lived through the dot-com bubble. And when we think about the dot-com bubble in the stock market, not only did we have the dot-com bubble burst, we had Y2K, and then we had 9/11, right? So that was 3 years back to back of just unfortunate stock market world events. So what would have happened, right? And we can look at that and say March 1999, which was one of the worst times to retire in the last 30 years, says that we would have gotten a raise at the beginning. So we would have been up $1,100. And then we do experience 9/11 and the market drops and we do end up having, we're right around plan for most of the next 5 years. So you'll see that the market didn't really affect our plan. And then 08 happened. So we did have to cut back in 08, $1,200 in this plan. So we talk to clients, hey, if we start with a plan expecting $12,300 a month and we have to cut back to $11,100 a month, Can you do that? Is that an acceptable amount of risk? Is that an acceptable cutback in lifestyle? And for most of our clients to think about the worst stock market returns, the worst life events that have ever happened, the worst world events that have happened in their lifetime, costing them $1,000 or $1,100 a month, they can say, I feel confident doing that, right? I can cut back 7-8% of spending if everything goes wrong. But we also tell them there are a lot of scenarios in history where things have gone right, and we can adjust up as well. And so a lot of times when we give them this type of context as they're on the edge of retirement, it really helps them to have the confidence and clarity to say, okay, let's do it. I'm going to go into my employer and let them know, December's my last month, and I'm ready to make this transition.
The other conversation that we have with clients in relation to discussing in history, this has happened. If it were to happen to you, there would be a shortage monthly of about $1,200 a month. If you're not okay reducing your expenses, would you be okay going to find $1,200 a month in the form of a part-time job, right? So being able to let them know, hey, how much you draw, this is exactly how much we have to reduce it. Can you replace that amount? And so there's just an additional level of peace of mind going into making the decisions going forward, knowing how much you can draw, knowing some of the changes that are coming and some of the changes you have to make that help impact your decisions going forward.
Yeah, I agree. And one of the other things we can do when we talk to a client, and our system allows us to do, is we don't have to start at $12,000 a month, right? We don't have to start there. If you know going into retirement that $1,000 reduction in expenses is not possible for you, right? Then we can make an adjustment to say, let's start at $10,500 now, right? We can start them at a lower withdrawal rate and a lower payout to start. And so then that means that the market would have to go back 50%, maybe 60%, right? And so we can actually, in our system, go through, start at a different original payout amount, and then see what these life events and these world events look like. And a lot of times we can get it to a point where you can ride through some of the worst experiences in retirement history without making any adjustments, but you just have to start at a lower payout amount.
The other benefit of being able to track and see how these different events would impact your retirement, help influence your decision going into retirement. So, okay, maybe I don't want to retire this year. What would it look like if I worked one more year? How much, if something happens, would I have to reduce my payout? So, hey, this monthly number looks really good. I like this number, but I don't want to have to reduce my spending by $1,200. Is there something different we can do around our Social Security spending? Is there or when we draw Social Security, is there something we can do as far as working an extra year, working an extra 2 years? What are all the different factors that play into helping make that decision?
Yeah. And there's a lot of, these are baseline plans, right? And there are a lot of additional tax things that we can do. So we haven't taken into account being able to do Roth conversions to have more money because we're paying less tax. One of the easiest ones is, do you have to be done at the end of this year? Can you go from making $96,000 a year, John, to making $40,000 a year volunteering or consulting? Because for every dollar that you earn outside of the house, we don't have to take it out of your investment portfolio. And so the longer you work, if you step down and work a part-time job, then that helps you to not have to lean so much on your investment portfolio. And when some of those stock market return bad years happen, they won't hurt as much because you won't be drawing as much. So there are things that you can do if this level is not enough certainty for you. But I think just knowing what your certainty level is, knowing what your spending level is, and being honest with yourself about how much spending you need to have and how comfortable you are cutting back in retirement really helps us to craft the plan that's best for you. Because at the end of the day, this is not our plan, right? We are creating the plan for you, the client, for you, John and Mary. So you know yourselves. Let's be honest about it on the front end, and let's craft a plan that you all can live with for the next 30 years. If you want to learn more about how Social Security is calculated and how you can maximize your Social Security, check out our next video.